What's up? It's your boy Goldspin7 taking a wild turn from this channel's past of self-help into underqualified financial advice, an internet path less trodden. Without further ado, this is my thesis. I think Open Door stock is being mispriced in relation to the new bipartisan housing law. I do not mean the housing bill equals all housing stocks to the moon. I also do not mean that corporate ownership ban equals every company that has ever touched a house is going to crater. Both of these are very surface level reads. The actual question is a lot narrower. What exactly did Congress prohibit? What did it preserve? And which side of that line does Open Door's business model fall on? Once you stop to read the actual language instead of stopping at the headline institutional investors banned from buying homes, this answer is a lot more interesting. The law generally prohibits a large institutional investor from buying additional single-family homes once it falls within the covered definition. The threshold is investment control of at least 350 homes. Now, Open Door had 3,420 homes in inventory at the end of its first quarter. So pretending it's too small to be relevant here would be inaccurate. Open Door probably does fall within the broader institutional investor definition. But that is not the end of the analysis, it is the beginning. The law also defines a category called an accepted purchase. That includes a single-family home that is newly constructed, renovated, or converted from a rental for sale by a large institutional investor, providing it is not being rented out while awaiting sale. Purchases made through that exemption are also left out of the post-enactment 350-day home calculation. And the purchase prohibition does not begin operating until 180 days after enactment. That is not minor. This is remarkably similar to the core Open Door model. Open Door is not primarily trying to accumulate a permanent rental empire. It buys inventory, assesses it, carries out repairs or improvements, and returns it to the for-sale market. Its economics depend on selecting the right houses, controlling holding costs, and turning that inventory quickly. Congress has now restricted one class of institutional demand: the institutions accumulating existing houses as long-term rental assets, while preserving a statutory lane for companies acquiring homes to renovate and resell. I am not saying this bill contains a hidden section titled Pump Open Immediately. I am saying the text appears to treat permanent accumulation and inventory turnover differently, and Open Door is positioned on the more favourable side of that distinction. This exemption is basically the best thing to happen to Open since God invented housing. This is obviously an exaggeration, but it potentially kills one of the cleanest regulatory bear cases against the company. Before this law, you could argue that growing political hostility towards corporate ownership of houses would eventually sweep iBuyers into a broad acquisition ban. Instead, Congress wrote an exemption that appears capable of protecting purchases involving homes renovated for resale. Independent policy analysts at the Institute for Progress have specifically discussed Open Door and OfferPad. Their analysis has concluded that these companies would likely qualify as large institutional investors, but could be exempt from when they renovate homes before selling them. That does not guarantee Treasury will implement every detail exactly as bulls like me expect. This is not something I invented while staring at a 1-minute candle. Serious housing policy analysts have identified the same potential application. So, at minimum, this legislation reduces regulatory uncertainty for Open Door. At best, it gives Open Door a relative advantage against institutional competitors whose strategy is buying existing houses and holding them indefinitely as rentals. But this bill alone is not the entire thesis. The more important point is that the underlying business already appears to be turning. Yes, the headline first quarter numbers look horrible. Revenue was down heavily year over year. Open Door lost $173 million on a GAAP basis. Adjusted EBITDA was negative $31 million. This is still a company with real execution risk operating in an incredibly difficult housing market. But if you look beneath the year-over-year revenue comparisons, several forward operating indicators are moving in the right directions. Home purchase increased 45% quarter over quarter. Open Door signed more than 5,000 acquisition contracts during the quarter, double its previous quarter at its highest level since 2022. The percent of homes sitting on the market for more than 120 days fell from 33% to 10% quarter over quarter. Contribution margins improved each month from September through till March. The October, November, December and January acquisitions cohorts was selling faster than any corresponding cohort since the COVID period, and fixed operational expenses fell from $39 million in the first quarter of the last year to $33 million this year. More acquisitions alone would be meaningless if Open Door was simply scaling bad inventory again. Faster resale alone could be produced by cutting prices and destroying margins. Better margins alone could come from the shrinking of the business into irrelevance. What we want to see is acquisition volume rising, old inventory falling, resale velocity improving, and contributed margins recovering and fixed costs remaining controlled. This is at least what management claims is happening now. For the second quarter, management guided to approximately 25% sequential revenue growth, contribution margins near the middle of its 5 to 7% target range, and adjusted EBITDA around break-even, plus or minus a few $1 million. Management is also targeting positive adjusted net income on a 12-month forward basis by the end of 2026. Quarter 2 is therefore the actual test. The housing law is the setup and the narrative catalyst. Q2 execution determines whether this becomes a legitimate operational turnaround. My bet is that Opendoor is rebuilding its unit economics before the housing market has even properly recovered. June existing home sales fell 2.4% from May to a seasonally adjusted annual rate of approximately 4.09 million. Mortgage rates remain elevated. The median existing home price reached a record $440,000. Affordability is still suppressing both buyers and sellers. That is obviously bad for a company whose revenue depends on housing transactions, but also makes the recent operating improvements more interesting. If Opendoor can produce better inventory selection, faster turnover and improving contributional margins while national transaction volumes remain frozen, may have serious operating leverage when activity eventually thaws. It does not need another 2021 housing bubble. It does not need instant 3% mortgages. It does need to prove that its newer acquisition cohorts remain profitable as purchase volume scales, and then it needs even a modest recovery in overall transactions. If Open can move from servicing fuck all of the housing market towards something like 1% while maintaining the newer cohort economics, the frozen market makes the current base look artificially small. Rate cuts or improved affordability would accelerate the thesis, not create it. I think the market still partially values Opendoor as though they are lighting shareholder money on fire by purchasing random houses selected by a malfunctioning Zillow algorithm. The more serious bull case is that it is rebuilding into a scaled residential transaction platform with improved inventory selection, faster turnover, improving contribution margins, and a cost base that does not need to rise proportionally with volume. Now included with a federal policy regime that restricts long-term institutional accumulation while expressly allowing certain homes intended for renovation and resale. The most solid bull path goes like this. First, investors realize that restrictions on institutional home buyers are not automatically hostile to Opendoor. Second, Q2 confirms revenue acceleration and approximately break-even adjusted EBITDA. Third, the newer cohorts demonstrate that margins survive while acquisition volume grows. Fourth, housing transactions eventually recover from historically depressed levels. And finally, Open gets re-rated from unprofitable house flipper to technology-enabled liquidity platform. That re-rating does not require the policy benefits to appear immediately in reported revenue. Market price expected future cash flows. The policy merely makes the future competitive and regulatory structure look slightly more favourable, providing the operational turnaround is real. Now, Monday, Moon Day. I would not claim this bill was completely unknown until Friday. Congress had already passed it, the enrolled language and carve-outs were publicly available, anyone paying close attention could have analysed it. What did change on Friday was the attention. The major headlines were about Trump refusing to sign legislation, the bill becoming law anyway, and Congress restricting Wall Street from purchasing of single-family homes. Those headlines brought the legislation back into the public conversation, but they generally did not explain how the resale exemption could have applied to iBuyers. The weekend then gave traders time to read past the headlines. That creates the possibility, not the certainty, of delayed narrative reaction when the market opens. I would not promise an immediate gap, but if substantial volume arrives, Open is exactly the sort of volatile, heavy, retail-followed ticker where a credible, fundamental catalyst can become reflexive. Price attracts attention, and attention attracts volume, and volume attracts more people trying to understand why the price is moving. That mechanism can produce a larger short-term move than the direct financial value of the legislation itself. My position is small in absolute terms because I'm very broke, but is most of my portfolio. Now, yes, there is a bear case. Treasury or the courts could interpret renovated much more narrowly than bulls expect. Opendoor may need to document that each acquisition genuinely satisfies the exemption rather than treating every coat of paint as statutory renovation. Mortgage rates could remain elevated. Housing turnover could stay frozen. Consumers may be unable or unwilling to buy the houses Opendoor needs to resell. Opendoor could misprice acquisitions, suffer inventory write-downs, burn additional cash, or miss its Q2 targets entirely. And some build-to-rent and renovate-to-rent transactions also receive exemptions, meaning the legislation does not simply eliminate every institutional competitor while handing the entire market to Opendoor. This legislation is narrative fuel, it is not a bomb. But the risk to reward looks compelling to me because the market does not need to believe that the law instantly transforms Opendoor's earnings. It only needs to recognise that one major regulatory risk may be a lot less severe than assumed, while the company demonstrates that its operating machine has become healthier.